Welcome to today's deep dive. I am so glad you could join us today because the mission we have lined up for you is, well, it's nothing short of extraordinary.
It really is. We are unpacking the fascinating Q4 2025 13F portfolio of Himalaya Capital.
Right, and specifically its founder, Li Lu.
Exactly.
Now, if you haven't been obsessively tracking institutional portfolios, a 13F is simply a mandatory quarterly filing. It gives us a delayed sneak peek into exactly what these billionaire fund managers are buying and selling.
And if the name Li Lu doesn't immediately ring a bell, let me frame his significance for you.
Please do, because it's wild.
Li Lu is the first and only outside manager that the legendary Charlie Munger ever entrusted with his own family's fortune.
His entire 95 years of life.
Yeah, think about the gravity of that for a second. The only one.
So today we are digging into financial filings, biographical insights, and a really comprehensive analysis of Himalaya's roughly $3.57 billion portfolio to see exactly how this master operates.
But before we get into the weeds of his specific methodology and his latest stock picks, I need to jump in for a quick word on our sources and some required housekeeping.
Go for it.
To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to subscribe on deepvalues.ai and research.deepvalues.ai.
And for the market trackers out there.
All right, to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Perfect. And the standard disclaimer.
Yes, just a quick reminder for you listening. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Okay, let's unpack this, because you really cannot understand Li Lu's incredibly concentrated portfolio without understanding the unbelievable life story of the man himself.
It's quite a story.
It is. We are talking about someone born in 1966 in Tangshan, China, right at the onset of a period of immense historical turbulence.
His childhood was marked by intense systemic hardship.
Yeah, his parents were relocated to labor camps, and he was bounced around between various foster homes. I know the early years were exceptionally rough, but how did that early environment specifically shape his psychological framework for Wall Street?
It forged an almost unbreakable foundational rationalism.
How so?
Well, when you spend your formative years navigating that level of societal upheaval, and then you survive the catastrophic 1976 Tangshan earthquake.
Literally watching the earth fracture beneath.
Exactly. In one of the deadliest natural disasters in recorded history, you develop a completely different baseline for what constitutes actual risk.
Which means a stock chart flashing red doesn't exactly trigger a fight or flight response.
That is the core of it. He developed an incredible capacity to remain perfectly calm under conditions of profound uncertainty.
Right.
He knows what true existential danger looks like, which allows him to view financial volatility purely objectively. A stock dropping 20 or 30% doesn't induce panic. It induces analysis.
He separates the emotional panic of the market from the mathematical reality of the business.
Precisely.
That objectivity becomes an absolute superpower when the rest of the market is losing its mind. And his trajectory from there just keeps escalating. As a young adult, he becomes a prominent student leader during the 1989 Tiananmen Square protests.
He ends up having to orchestrate a clandestine escape through Hong Kong, then to France, and eventually lands in New York City at the age of 23.
But the leap from a political refugee arriving in a new country to a Wall Street heavyweight is massive. How did he actually bridge that gap?
It started with an absolute relentless pursuit of education at Columbia University. In 1996, he accomplished something unprecedented.
The trifecta.
Yeah, he became the first student in Columbia's history to simultaneously earn a bachelor's in economics, a law degree, and an MBA.
Concurrently. That's just insane.
It really demonstrates his remarkable ability to synthesize massive complex systems. He wasn't just learning basic finance. He was all at once.
But the real pivot point, the moment that defined his entire career trajectory, happened a few years earlier in 1993, sitting in a lecture hall.
Right.
And it's funny because prior to this moment, he supposedly viewed the stock market with big skepticism, seeing it as a manipulated casino.
Coming from his background, capital markets looked like pure gambling. But that 1993 lecture was given by none other than Warren Buffett.
Of course it was.
And Buffett provided a completely new mental framework. He explained that a stock is not just a ticking line on a screen to bet on. It is simply a fractional ownership interest in a real breathing business.
And crucially, Buffett taught that the market is there to serve the investor with opportunities, not to guide the investor's judgment.
That concept clearly flipped a switch for him. He starts investing his student loan money, actually finds real success, has a brief stint in investment banking, and then launches Himalaya Capital in late 1997.
But the real rocket fuel gets added to the mix in 2003. At a Thanksgiving gathering, he meets Charlie Munger.
Munger immediately recognizes this exceptional analytical mind completely free from the standard dogmas of Wall Street.
And Munger does something he had never done before. He invests $90 million of his own money with Li Lu. What kind of numbers did that partnership actually produce over the years?
The results were nothing short of stunning. Between 2004 and 2009, Li Lu's fund achieved a 36% annual compound growth rate.
36%? Wow.
Yeah, and when you zoom out, since its inception in 1998, it has returned over 29% annually.
That is wild.
But Munger provided more than just capital. He became a lifelong mentor. Together, they optimized the very structure of Himalaya Capital to eliminate the typical short-term pressures that hedge funds face.
Right, removing the focus on monthly performance metrics.
Exactly, allowing Li Lu to focus entirely on long-term capital compounding without worrying about impatient clients pulling their funds during a temporary downturn.
So we have this legendary partnership and incredible returns, but I want to break down his specific investing philosophy for you listening. Because Li Lu isn't just a carbon copy of the Buffett-Munger playbook.
Yeah, definitely not.
He took those core tenets and really evolved them. How does he actually filter his ideas?
Well, he adheres strictly to the classic pillars, demanding a margin of safety, viewing stocks as business ownership, and utilizing Mr. Market as a servant.
Right.
But what's fascinating here is his absolute, uncompromising insistence on what he calls intellectual honesty and the circle of competence.
Let's define that for the listener.
Sure. Li Lu adopted Munger's strict definition. If you cannot refute or disprove your own investment thesis better than the smartest, most qualified person on earth who holds the opposing view, you do not possess true competence in that area.
You basically have to become your own harshest critic. You have to actively try to destroy your own brilliant idea, anticipating every possible flaw in your logic before you put a single dollar down.
It requires suppressing the ego entirely.
Because human psychology naturally wants to confirm our own biases.
Right. Fighting that instinct takes incredible discipline. In his view, competence without strictly defined borders isn't competence at all. You have to know exactly where the edge of your knowledge stops, and you must refuse to step past it no matter how tempting a new trend might be.
And that extreme discipline naturally forces extreme concentration in the portfolio.
Exactly.
Because when you look at the Q4 2025 13F filing, that concentration is undeniable. We are talking about a $3.57 billion portfolio, and he holds exactly 9 stocks.
9.
Just 9. I feel like holding just 9 stocks in a multi-billion-dollar fund would give the average retail financial advisor a heart attack.
Yeah.
They're constantly preaching massive diversification.
And for the average investor, broad diversification is the safest route. But for someone utilizing Li Lu's methodology, this extreme concentration is a feature, not a bug.
It's the ultimate expression of risk management.
Yes. He only invests where he has absolute certainty. And a major part of that certainty comes from his localized expertise and his unique macroeconomic view, specifically what he calls the modernization of China thesis.
I want to make sure we ground this concept for the listener because it sounds a bit academic.
Right.
What does that thesis actually look like in practice, and how does it influence his stock picking?
He views China's economic rise not as a temporary phase or a cyclical boom, but as a long-term civilizational transition into a modern market economy. He analyzes this through a modernized Confucian lens.
Right.
There is a traditional Chinese concept called the literati spirit. This philosophy emphasizes personal integrity, self-cultivation, family building, and acquiring wealth in order to ultimately help the broader world.
So Li Lu believes this cultural framework is highly applicable to modern commerce in Asia.
Exactly.
It's not just about ruthless, extract every penny capitalism. He's looking for companies that actually serve a foundational societal function, which in turn gives them a much longer, safer runway to grow.
That cultural fluency allows him to identify long-term compounders in Asian markets that Western investors might completely overlook, simply because they don't grasp the local institutional and cultural dynamics at play.
This really highlights how he's separated from the old-school Benjamin Graham style of value investing. You know, the classic cigar butt strategy?
Right.
Where you look for a dying company trading below its liquidation value just to get one last cheap puff out of it before it goes bankrupt.
Under Munger's influence, Li Lu shifted entirely away from cigar bets. He focuses on finding truly great growth-oriented compounders at reasonable prices.
We have a good example of that.
The perfect example from his history is the electric vehicle maker BYD. He held that stock through multiple massive market cycles. He watched the share price drop by as much as 80% at certain points.
80%.
Yeah, but he never panicked and sold because his deep research showed that the intrinsic value of the business was continuing to compound year after year.
Here's where it gets really interesting, though. Let's dig into this newly released Q4 2025 13F filing and see what he's actually swinging at right now.
Let's do it.
Looking at the heavyweights, the single biggest holding by a massive margin is Alphabet. Across their Class A and Class C shares, Alphabet makes up over 43% of his entire $3.57 billion portfolio.
It's huge.
Almost half the fund in one single tech giant. What is the fundamental thesis there?
For Lailu, Alphabet isn't just a technology company. It is the ultimate toll bridge of the information age. The economic moat surrounding Google search is arguably the widest in commercial history.
Built on those massive self-reinforcing network effects.
Right. More users generate better data, which creates better search results, which attracts even more users and consequently more advertising revenue. It's a closed, virtuous loop.
And when you look at the financials for 2025, Alphabet's return on common equity, or ROE, sits at a staggering 35.7%.
That's incredible efficiency.
For you listening, ROE measures how efficiently a company generates profit from its shareholders' equity. Generate nearly 36 cents of profit for every dollar of equity at Alphabet's gargantuan scale is incredible. It's like steering a massive cargo ship with the agility of a jet ski.
Furthermore, they are successfully evolving their ecosystem. With their Gemini AI models, they are transitioning from simply providing a list of blue links to providing direct synthesized answers,
Which deepens user engagement.
and keeps people inside their ecosystem for longer durations. But while Alphabet acts as the massive growth engine for the portfolio, the foundation is built on financial bedrock. Bank of America at 16% and Berkshire Hathaway at 12.6%.
So he's allocating almost 30% to these legacy financial institutions. Why do these two specific companies serve as his defensive anchors?
They provide vital exposure to the fundamental resilience of the American economy. Let's look at Bank of America first. Its primary moat is sheer scale. As of 2025, Bank of America has a staggering $1.9 trillion deposit base.
That is just a massive mountain of low-cost funding that smaller regional competitors simply cannot replicate.
It gives them an insurmountable structural advantage. They delivered $30.5 billion in net income in 2025, proving to be a highly efficient capital allocator under their current leadership.
And then there is Berkshire Hathaway. Holding the company as mentors is an acknowledgement of the unparalleled durability of their business model. Let's explain why Berkshire is the ultimate defensive weapon.
Sure.
As of this filing, they are sitting on a record $373 billion in cash, alongside $176 billion in insurance float.
That's the key.
For anyone unfamiliar, insurance float is basically the premium money you pay upfront for policies. Berkshire gets to hold that money and invest it and keep the profits for years before they ever have to pay out a claim. It's effectively free leverage.
And they take that free capital and deploy it into cash-generating hard assets like railways and energy infrastructure. This structure allows Berkshire to thrive in literally any economic cycle. Holding it provides Lailu with the ultimate margin of safety.
So we have the toll bridge and the defensive anchors. Let's pivot to the tactical plays that really show his unique eye. Sitting right there in the middle of his portfolio, taking up 14.6%, is PDD Holdings, the company behind Pinduoduo and Temu. This is described as a growth value play. Let's break down the mechanics of their business.
PDD is the paradigm of what we might call radical efficiency. Their economic moat is based on a consumer-to-manufacturer, or C2M model.
How does that differ from normal retail?
Think about the traditional retail supply chain. A factory makes a product, sells it to a brand, who sells it to a distributor, who ships it to a retailer, who finally sells it to you.
Every single step adds a markup.
Exactly. PDD aggregates massive consumer demand and connects buyers directly to the factory floor, cutting out the middleman entirely.
Which allows them to offer extreme value. That is a massive advantage in a global environment where consumers are dealing with persistent inflation and are actively trading down to stretch their paychecks.
And the numbers they are pulling are wild. For an e-commerce company to boast a 25% net profit margin is almost unheard of. Plus, they have a fortress balance sheet with nearly $59.5 billion in cash and virtually zero debt.
Yet the stock trades at a massive 70% discount to its estimated fair value.
Right. It's trading with a forward PE of just 11 or 12.
Let's give that some context for the listener. When you consider that the broader market is sitting closer to a 20 or 25 multiple, right now, the market is pricing this high-growth tech juggernaut like it's a slow-moving utility company.
Yeah.
Why the massive disconnect?
That discount is entirely driven by broader market fears regarding geopolitical tensions and regulatory risks in China. Lailu is willing to underwrite that geopolitical risk because the underlying cash flow generation of the business is so undeniable.
We see this localized expertise applied again in his 8.7% holding in East West Bancorp. That's a regional bank. Why them instead of another massive national player?
Because East West Bancorp operates as a specialized gateway for trans-Pacific trade. They possess deep, localized relationship networks within the Chinese-American business community.
Massive national banks cannot easily replicate those cultural and business ties.
Right, which allows East West to maintain higher profit margins while carrying lower credit risk.
He also has a 1.7% position in Occidental Petroleum, or OSY. It's not just a traditional oil play in the Permian Basin. It has a dual moat because of its Stratos direct air capture project. He's positioning himself for the future of industrial decarbonization and carbon credits.
But we have to talk about the newest Q4 2025 portfolio change.
Yeah, he made a complete 100% exit from Sable Offshore,
What?
basically liquidating a 1.34 million share position he had just started building the year before. And he replaced that capital with a brand new 1.5% position in Crocs.
Yes, the rubber claw company.
It feels incredibly ironic that a legendary Munger protege is backing foam shoes. What is the thesis here?
Well, the complete exit from Sable Offshore perfectly illustrates his intellectual honesty in practice. If the underlying thesis changes or his conviction drops, he doesn't trim the position around the edges, he ruthlessly cuts the entire thing.
And the entry into Crocs.
That is a classic consumer brand play. Crocs has achieved this bizarre cult-like status among younger demographics and medical professionals. More importantly, they use a proprietary injection-molded material called Croslite,
which makes the shoes incredibly cheap and efficient to produce, resulting in massive gross margins.
You combine that manufacturing efficiency with their aggressive expansion into Asian markets right now, and the numbers become very compelling. They are projecting 51% annual earnings growth, and the stock was trading roughly 46% below its intrinsic value.
It hits every single one of Lilu's metrics. An easily understandable high-margin business trading at a steep discount. So what does this all mean for you and me looking at our own portfolios? When you look at Alphabet's Tollbridge, Berkshire's cash pile PDDs, radical efficiency, and even high-margin Crocs, what does this snapshot of Lilu's brain tell us about the global macro outlook for 2026?
If we connect this to the bigger picture, Lilu is clearly positioning for a very specific macroeconomic reality. He has publicly expressed profound concern regarding the oversupply of global currencies by central banks.
Right.
Base currencies have expanded astronomically, but that expansion hasn't translated to real economic growth in the underlying economy. As a result, wealth is naturally concentrating in high-quality, scarce assets while the real economy stagnates.
Which explains the massive Alphabet position. If currency is being continuously debased, you want to own the asset that takes a percentage cut of all digital commerce intention, regardless of what the underlying paper currency is actually worth.
And if we look specifically at his China thesis for 2026, what the Chinese zodiac calls the year of the fire horse, he sees a period of muddling through. Yeah. Domestic demand within China is relatively weak as they try to transition away from a property-based economy. However, their export sector remains incredibly resilient because they are diversifying globally.
This perfectly validates his massive high-conviction bet on PDD and Temu. They are engineered to thrive in a deflationary, cost-conscious environment by exporting extreme value directly to global consumers.
It's all so deeply interconnected.
It reminds me of the tribute Li Lu wrote for Charlie Munger. He said that true value investing is specifically designed for the most difficult times. It's not just a bull market strategy where everything goes up. It's a defensive posture designed first and foremost to prevent the permanent loss of capital.
You protect the downside with deep understanding and a margin of safety. If you do that rigorously, the upside takes care of itself.
To bring this all together for you listening, looking at Himalaya Capital's Q4 2025 portfolio isn't just about getting a list of stock tickers to copy. It's about absorbing a methodology.
Definitely.
Li Lu's approach is a masterclass in risk management achieved through deep localized understanding. It's about choosing rationality over emotional market swings, demanding brutal intellectual honesty from yourself, and knowing exactly where the boundaries of your competence lie.
If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel at Deep Values. Don't forget to like this video. Much appreciated.
And we'll leave you with a final thought to ponder.
With Munger gone and the 2020s seeing profound geopolitical shifts in currency oversupply, what happens to businesses that rely entirely on a smoothly integrated global economy if that system fractures further? Is the ultimate margin of safety today found in a massive cash pile like Berkshire's or in an undeniable consumer value proposition like PDD or Crocs?
That is the multi-billion-dollar question. Thank you for joining us on this deep dive. Keep questioning your assumptions, define your circle of competence, and we'll see you next time.